Hello and welcome to my new lecture of investment analysis and portfolio management. Today we are going to discuss chapter number 5 of the book written by Frank Carelli and Keith C. Brown. But along with that, we will discuss and understand the composition of KC 100 index. So this video lecture is of great interest to all those who want to know how the KC 100 index is selected, the 100 companies are selected, and how it is calculated. So it will be of a great interest to those individuals as well. So let's start with the formal lecture. After this chapter, the chapter is about security market indicator series, that is the stock market indexes. And by the end of this chapter, you should be able to answer the following questions. That is, number one, what are some of the major uses of security market indicator series, that is indexes? That for what purpose we can use them. The second is, what are the major characteristics that cause alternative indexes to differ, that how one index is different from the other index, so on what basis they are different from each other. And the next one is, what are the major stock market indexes globally and what are their characteristics. So world over, in Pakistan we know that KC 100 index is the most commonly used index, but then what are the different market indexes globally that are very famous, and what are their characteristics. And last one, obviously the most interesting one for the locals, that is how the KC 100 index is composed, mean how the companies are being selected. So what are those 100 companies and how they are being selected. So let's start with it. The uses, the first thing is the uses of the security market indexes. The first one is that it can be used as a benchmark to evaluate the performance of professional money managers, mean the investor, the portfolio managers, as we discussed in chapter number 2 about the policy statement we discussed, and then we say that how the performance of a portfolio manager can be evaluated. So the index is generally used as a benchmark, that it is against which the performance of the portfolio manager are being evaluated, that whether you have performed better than the stock exchange as in overall, that is the index, or you perform below that. So it can be used as a benchmark against which the performance of the portfolio managers or money managers, wealth managers, can be evaluated. The second is to create and monitor an index fund. The point is that if an investor is unable to diversify its portfolio properly, so then what the person can do is it can invest in the index companies in the same way, or some mutual fund can create its own index fund, that the money will be distributed or invested in that fund in the same proportion as it is the companies are included in the index. So through this you can track the performance of the overall index. To measure market rates of return in economic studies, that a lot of finance research is being carried out, and there we want to calculate the returns and the abnormal return, the return earned above a certain level. So in those studies the indexes are being used as a measure of the market return, the overall market. So there we can say that the returns are then compared with the individual security or another portfolio formed by an individual portfolio manager. So for that purpose, the market return, when we use the word market return, so for that we use the index return as a proxy for that. The next one is for predicting the future market movement by the technician, mean there are fundamental analysis, there are technical analysis. So there are some individuals who are actually predicting the future movement of the stock exchange based on the historical data. So they are using the market indexes for that reason, that if the index increases by 3 days, so the 4th day it will decrease. So in or if the volume increases by a certain percentage on daily basis for the for a week, so then what happens into the stock prices on the next day. So this is what we call as technical analysis. So these technicians can use the market indexes to predict the overall the market performance, and then they can predict the future based on that. And lastly, as a substitute for the market portfolio of risky assets when calculating the systematic risk of an asset. So when we are using, we want to calculate the beta. So for the beta, we will discuss it in chapter number 7 or chapter number 8 in more detail. So the beta is the covariance of a security with the market divided by the variance of market. So in that case, for the market, we use the index. So index is used as a substitute for measuring the market performance, and for that reason you are able to calculate the systematic risk of an asset, that is beta. So these are some of the uses. Remember, one of the major use which we can include in the first one, that most of the time when you say the country is performing well or the country is not performing well, so a lot of people, they refer to the stock exchanges, that if the stock exchange is performing well or if the stock exchange is performing poorly, so that actually reflect the, and know how the government is performing. So there is also a major use, that's why these stock exchanges, they are considered as the barometer of the economy. So, and in that, generally we refer to the indexes, generally, that the Karachi Stock Exchange 100 index closes at, let's say, 33,000 points or 35,000 points, or it increased to 40,000 points. So that actually reflects the economic performance of a government. So these are some of the major uses. Now the next one is how the indexes are different from each other. How one index is different from another one. When we say KC 100 index, we say there is KC 30 index as well. There is a KC all share index. So how these indexes are different from each other. Similarly, we can compare it to the New York Stock Exchange indexes. We can compare it to the London Stock Exchange indexes. So how these indexes are different from each other. So there are certain factors. The first one is based on the sample. You know, an index can be different from each other in terms of the sample size. The first factor is sample size. That when we say KC 100 index, it means there are 100 security companies included in this. When we say KC 30 index, it means there are 30. So even if all other things are the same, the size is different. So obviously when we will track the performance of these two indexes, there will be differences. In 100 and in 30 there is a difference. The next is the breadth. The breadth mean that there are, let's say, 500 companies included, listed, are around 500, a little more than 500 on the Karachi Stock Exchange. So when we say there are KC 100 index, it's cover almost 1/5 of the total companies in terms of number of companies. But then based on the size of the company, it can cover more than 70% or 80% of the total stock exchange, because larger companies are generally part of the index. So that is the breadth. On the other hand, let's say there is another index of New York Stock Exchange. If it is a 100 index, so in the size term they are the same, because they're having 100 companies and we are having 100 companies. But in the New York Stock Exchange, it may cover only 20% or 15% of the total, in terms of the capitalization, and in terms of number, it can be even less than 5%, because there are thousands of companies listed on the New York Stock Exchange. So how much percentage of the total companies listed on a stock exchange, or how much total capitalization listed on a stock exchange is included in the index, that is what you call as the breadth. And the last one is the source, from where the companies are actually being selected. They are selected from a particular sector, or it covers all the sectors. All the sectors are being represented there. So that is the source, that how from where these companies are actually being selected. So it can be different. There can be indexes which are only based on the financial sector. There can be companies which include all sectors. There can be companies which are only indexes which are only related to the technology related. So that is the source. So it can be different in terms of number of companies included. The breadth mean how much of the total companies listed on a stock exchange are being included, and from which sources those companies are actually being selected. The second difference in the index is the weighting of the sample members. Mean once the company is being selected in the index, how whether these companies are being considered as equal. There can be huge differences in the size of the company. So whether they are being considered as equal companies, all are assigned equal weights, or they are different. So can be the weighting can be based on the total value of the company, or it can be based on the price. So these are the differences, that it can be the weighting can be based on the price weighted index series, There can be value weighted. Value weighted mean that when we multiply the number of shares of a company with its current price, so the total value we got, we call it as market capitalization of the company. So whether the companies are valued based on that, that is what we call as value weighted series. Unweighted or equal weighted series mean that all the companies included in the index, they are being considered as equal. And the fundamental weighted series, they are indexes, these are relatively new, but this is based on some fundamental factors, that is the earnings of the company or the return on equity of the company. Based on that, we are actually assigning the weightage to the companies. So these are the four, but we will be discussing the first three in more detail. The fundamental weighting index, they are not very common, so we will not discuss them in greater detail. The next one is the computational procedure, mean how they are actually being calculated, whether it is based on the arithmetic mean. We know that from chapter number 1 or 2 that it can be arithmetic means, it can be geometric mean. So whether the changes in the stock prices and the index, they are based on the arithmetic mean or they are based on the geometric mean, or it can be computed and indexed and have all the changes, whether it is in price or value, reported in terms of the basic index, mean that all the changes are being included and then it is being reported in the form of an index. Remember, we will be more focusing on the arithmetic mean side of the index. That is the most common one that we will be using. Next one is, now here comes that the price weighted index. The price weighted index, the most common one and probably the oldest one is the New York Stock Exchange index, that is Dow Jones Industrial Average. It is a price weighted index. And the next one is Nikkei Dow Jones Average, that is the Japan market index. These are the price weighted index, the most common one they are being used. We'll discuss the limitation of price weighted index and that they are not very good, or the Dow Jones itself, that it has a 30 index, so it only tracks the prices of 30 companies, which is very small in sample size. Value weighted index, the New York Stock Exchange Composite Index, that is the S&P 500 index, they are value weighted index. The Pakistan Stock Exchange Index that we are talking about, the KC 100 index, it is a value weighted index. So there are many indexes which are value weighted index. Most commonly used indexes are value weighted indexes. And the last one is unweighted or equal weighted indexes, and they are not again very common. So there is Financial Times Ordinary Share Index and there is a value line average. So these are some of the examples that different indexes using different weighting criteria. Remember, I have told you that we will not use the fundamental weighted index series, that is not very common. So here come the first one, how the price weighted index is actually being calculated. So the Dow Jones Industrial Average that we are talking about is the best known or the oldest and the most popular index in the world. It is a price weighted average of the 30 large well-known industrial stock leaders in their industry and listed on the New York Stock Exchange. Now we are not going to discuss the procedure through which these 30 companies are being selected, but you should generally know that these are generally the largest companies listed on the New York Stock Exchange, and they are leaders in their own sector. But remember, all the companies, probably there are more than 40 to 50 sectors on the New York Stock Exchange. So it does not mean that all the leaders are being included. There are only 30 companies, so only 30 companies are being included in that. So the procedure can be very difficult. We will only discuss the procedure of selecting the KC 100 index in Pakistani context. But for the New York Stock Exchange, the Dow Jones 30 industrial average, which is based on a 30 companies, they are generally the largest companies. So how it is being, the index is being calculated. The mathematical side we will do in a Excel based calculation, but here I'm just explaining the formula a little bit, that the current prices of all the 30 stocks, and then it is being divided by a divisor. Remember that the original divisor was 30, but then with the passage of times, when companies are issuing dividends, issuing new stocks, or they are splitting their stocks, with all that the divisor keep on changing. So how we do that, it is being done through an adjustment, and we will discuss it in this video as well, and then in the Excel based video that I'll upload later on. So the Dow Jones Industrial Average is calculated being sum of the prices, the current prices of the 30 companies. I from 1 to 30, that we sum the prices of all the 30 companies included in the Dow Jones Industrial Average, and then we divide it by a divisor. So there is a divisor, and then the value that we get is the index. So here it is being explained, that is the value of the Dow Jones Industrial Average at any given day t, that is day t. That is the closing price of stock I on that day t, and that is the divisor on day t. So remember that I have told that the original divisor was 30, but the current divisor is very small. The current divisor is around 0.145 something. That is due to large splits and dividends and all the things. With the passage of time, the divisor has decreased, and now it is less than 0.15, mean that is something around 0.14. And once you'll see my video, probably by that time the divisor might have dropped down further. I'm talking about in somewhere around May 14 2020, where the divisor is around 0.14 something. It is a large number. Now here is the demonstration that how the price weighted index series work. So let's say we cannot take 30 companies, so we just take 3 companies, A, B and C, and we are taking the initial time, that is period T. And let's say that the price of A company, those are the 3 companies which are included in the index, that is 100, the second is 50, and third one is 30. So what we do is we calculate the sum of the prices. That is what we did. We say in the previous, let me just show it, that this is what we were talking about. We calculate the sum of the prices, So once we do that sum of the prices, that is 180. And the original divisor, as I discussed, in that case it will be 30, but here it will be 3, because there are 3 companies included. So this is 180 divided by 3, and so the average that we will get is 60. So that will be the value of, since there is no initial value assigned, we will discuss in the other indexes that initially some value is assigned to it, but in Dow Jones Industrial Average the first value was like 60, and that is the Dow Jones Industrial Average value, index value on day 1, the first day. Now let's say if the price increased to 110, for this one it remained 50, and for this one it increased to 30. So what happens is that the price will become 190. So if there is no split and reverse split, so as a result what will happen, that the divisor will remain the same. So if the divisor is 3, so you'll get what? We'll get 63.3. 190 divided by 3. You can do it with your own calculators. It will be 63.333. But so once you say that how much is the change, so the change is 63.3 minus 60 divided by 60 into 100, and you'll get an answer of 5.5%. So if the value of the first security has increased by 10% and the other 2 securities remain constant, the overall index will increase by 5.5%. Now I'm just explaining that how the price weighted index is working. Now remember, there is a 10% increase in the securities A price. Now in the B case, we keep its price constant and we increase the price of C security by 10%. So when you increase the price of C security by 10%, it will become 33, and then the total sum will become 183. So if the divisor remains 3, we will get an answer of 61. And if we compare it to the original one, that is to 60 and 61, so the increase is 61 minus 60 divided by 60 into 100, and you'll get 1.7%. What does it mean? Now let's read this. Demonstration of price weighted index calculation and the impact of differently priced securities on it. Mean that why it is known as a price weighted index, that if a company has a larger price and if its price increases by 10%, it will bring more changes in the index, that is 5.5%. Remember that the price has increased by 10%, but it brings more changes. On the other hand, the C company, if its price increases by 10%, that is from 30 it increased to 33%. So it's same, that this increased by 10% or this increased by 10%. But since C company is a smaller company, as a price, its weightage is less. Its weightage is less in the index, and that's why it brings less changes in the overall index. This makes the price weighted index or the Dow Jones Industrial Average Index a little, it's not very effective. The reason is that companies which are having very large prices, they carry more weightage, and as a result, when their price increases or decreases by a certain percentage, it brings more changes. While on the other hand, a company which has a lower price, but the company may have a very large number of shares, so maybe the overall size of the company is larger, but since its price is lower because its number of share outstandings are very high, so when there is a change in the price of that company, since the percentage change can bring less changes, therefore the contribution of that particular company can be less. Though on the other hand, that company may have more impact as an overall market because its overall market size is larger, but since we are not including the number of shares into it, therefore it's companies then don't split their shares, and you will see that there are companies which are having very large prices included in the Dow Jones Industrial Average. Remember, in terms of dollar, it's large. So here, how the divisor is actually being adjusted. We discussed that the divisor is actually being adjusted when there is a split or there is a reverse split of stocks. So here is the example, that let's suppose I'm just taking that this A company has, this is a different example, remember, so it's not related to the previous one. There we were just discussing that how the different price securities can impact the index. Here we are actually understanding how the divisor will be adjusted once there is some change and there is some split. So let's say company A has 5,000 shares, B 8,000, and C 20,000 shares, and their prices are 30, 20, and 10. So once you'll calculate the sum of these 30, 20, and 10, we'll get 60. And since the divisor is 3, so you'll get a value of 20. So the index value would have been 20. Now let's say in the second one that this A company has split its shares, and its shares are, one share is split into 3 shares. So what happens is that its shares become 15,000. From 5,000 it increased to 3 times increase, so there is 15,000. For B and C it remained constant. Now let's suppose if there is no economic activity has taken place, the price of this stock will drop down to 10, because the number of shares increased from 5,000 to 15,000, 3 times increase, the price will decrease from 30 to 10. This will divide by 3. This is actually the number of shares multiplied by 3, the price divided by 3. So the new sum that we will get will 10, 20, and 10, we will get 40. Now remember, if we still divide it by 3, the answer that we will get will be something around 13.33, and it will show that the index has performed very poorly. But actually it is not a poor performance, rather the price has not decreased, it was actually decreased because of the increase in number of shares. So then we need to adjust the divisor. So how we do it, we will say that this average should remain constant, this value should remain constant. So it means that we can now determine this new factor. So what we'll do is that the new sum, that is 10, 20, and 10, 40, the divisor now is unknown, so we put an x to it, and we say that it should be still equal to 20. So when we say it is 20, so the divisor that you'll get is 2. So this will be the new divisor. Now this is how the divisor has decreased from 3 to 2. And let's say if there is another company, this company split its shares from 8,000 and it make it 16,000, and its price also decreases to, let's say, 10. So then the new average will become what? It will become 30, and then this divisor, which would be 2, will further drop down, because if you want to maintain it at 20 and the overall sum is 30, so obviously the divisor will drop down to something around 1.5. And this is how the divisor is being adjusted, and this is why I'm saying that the divisor has adjusted so many times in the the Dow Jones Industrial Average, that now it is around 0.14 something. Criticism on this index is that, number one, as I told you, that it's limited to only 30 non-randomly selected blue chip stocks. There are thousands of stocks and this is only 30, and those are the the largest companies, so it may not be representing the overall market. Does not represent a vast majority of stocks, because out of thousands, if you are just selecting 30 and you say that this is actually representing the overall market, so it's not a good one. The divisor needs to be adjusted um, every time one of the companies in the index has a stock split. So as I discussed in the previous slide, that whenever there will be a split in the shares, the divisor will be adjusted, and it's been adjusted so many times that it has dropped down to a value of 0.14 something. Introduces a downward bias by reducing the weightage of fast growing companies whose stock splits. What happens is that if a company is very fast growing, so its price keep on increasing at a very high rate, so what happens is that it goes beyond the purchasing power of the investor. So what the company is doing is that it is keep on splitting its stock so that it should become manageable for the investor to purchase. But when the company will be splitting its stocks, what happens is that its weightage in the index reduces, and that's why some of the companies are not even, which may required otherwise to split the stock, is not, they are not splitting the stocks, because that it decreases their weightage in the index. So to avoid that, a company want to have more weightage in the index, they may not you know split the stock, which otherwise would have been a better thing for the investor to split the stock so that everyone can purchase it. The value-weighted index series drives the initial total market value of all stocks used in the series. That how it has been done, as I told you, that we calculate the market value of the index by doing what? Multiplication of number of share outstanding of that company into the current market price of that company. So that gives you the market capitalization or the market value of the company. So whichever company has the highest market capitalization, that is actually being included in the index. Generally we assign a beginning value to it, as I discussed earlier, that we generally assign an initial value to it. Maybe it is 100 or 1000. So remember, in the KC 100 index perspective, the initial value was 1000. So when we start the index, we generally start that, let's say assign a 1000 points to it, and then when whatever changes it will happen, that will track the performance of that index from there onward. uh, the good thing about it is that if there is a split in the stocks, there will be no adjustment required in the kind of divisor. It is automatically adjusted, because if you split the stock, just like in the previous case, that the market value will remain the same, that if there is a split in the stock and the price has dropped down, that if we just, let me just show you that how it could have been, that let's say in this case, this is 5000 into 30, the market capitalization would have been how much? 150,000. I hope I'm correct, but you can get the value. That will be like, there will be 4 zeros and there will be 3 into 5, that is 15. So it means the value would have been 150,000. Now in this case, if you split the stock from 5000 to, let's say, 15,000, but the price has dropped down to 10, so still you multiply 15,000 by 10, you will get the same value of 150,000. So it is automatically being adjusted. Since in the price weighted index, I put these number of shares just for understanding purposes, but in the price weighted index, since the number of shares are not there, so if we just ignore these number of shares and we put, make the calculation based on these prices, and if you don't adjust the divisor, the value would have been very small, and it would have shown that the performance has dropped down significantly, which not is the case, because it was due to a split. So on the other hand, in the value weighted index, now let's move again to that slide. In the value weighted index, the value will remain automatically adjusted, because that there will be, when the share increase and the price has decreased, so automatically there is an adjustment. The weighted depends on the market value of the company. So in the previous case, the market weightage of the company will remain constant, because 150,000 previously, 150,000 after the split. So if there is no increase in the price, it means its weighted will remain constant. How the value weighted index is actually being calculated? So what we do is we calculate the current sum of the companies included in the index, their current market value, the sum of all those companies, mean price into quantity, price of the per share into the number of share outstanding of each company, and then we sum all the values. Let's say if we say it is in case the 100 index, we mean the 100 companies price, current price, and their current number of share outstanding, they are being multiplied, and then it is divided by the base value of price and its number of share outstanding. So that is the index, the current value over the base value. And then generally we assign a beginning value, and in Pakistan Stock Exchange, Karachi Stock Exchange 100 index mean that was 1000. It was started in 1991, so that 1000 value was assigned to it. So this is how it is being calculated. So this is being explained where index, it will give you the index on a particular day. P is the ending price or the closing price of a stock on day T, any given day. That is the number of share outstanding of that stock on that particular day, and this is the ending price of the stock on the base day, when the index was actually being started, and that is the number of share outstanding of that company on that base day. So it is actually comparing the current value to a base value, and that is what we call as an index. The last one is the unweighted or the equal weighted index. So it means that all the stocks carry equal weightage regardless of the price or the market value. So we are not giving any weightage to the price, or we are not giving any weightage to the total value of the company. Once the companies are being selected in the index, they all carry equal weightage. So let's say if there are 4 companies, so all the companies will carry a weightage of 25%, 25%, 25%. If there are 10 companies, each company will have a weightage of 10% each, and so on. For let's say if there are 50 companies, so each company will have a weightage of 2%. So may be used by individual who randomly select stocks and invest the same amount in each stock. Let's say if as an investor you say that I'm going to invest in 20 different stocks, and I have an amount to invest of, let's say, 80,000. So it means if you want to invest 80,000 in 20 different stocks, so it means you will invest 4,000 in each stock. So it means if a company has higher price, you will get less number of shares of that company. If a company has a lower price, you will get more number of shares of that company, but the overall investment will remain constant. It means the weightage of that company in your portfolio will remain the same. That is, if you have purchased 20 stocks, so it means every stock will carry a 5% weightage in your portfolio. Some of these uses the arithmetic averages, while other use the geometric averages while calculating the performance of that index, the price changes for the stocks in this kind of index. Let's discuss that. Let's say in this case we take 3 companies A, B and C, and we put an initial investment. Let's say if you have a total investment of 15,000 and you put 5,000, 5,000, 5,000 in each company. Now let's say if there is the price of this company is 100, you will get 50 shares. The price of the price is 50, so you'll get 100 shares. This is the total amount invested divided by the price, so you'll get 100 shares. Now if the price is 20, you will get 250 shares. Remember, the total value is 5,000, but now you will get more share because its share price is low. And let's say if it is the price is only 10, so you will get 500 shares. Now once the company will split, a particular company will split its shares. So if this company split its share to 4, one share is split into 4, so what will happen, that the price of this company will drop down to 12.5 rupees or 12.5 whatever currency that you are talking about. So what will happen, on the other hand, the number of shares you were actually having before the split were 100, and now your number of share held will be 400. So 400 multiplied by 12.5, you will get the same value of 5,000. So it means that once the split has taken place, the number of share that you are carrying will also change. You mean that you will return your 100 shares, and in return you will get 400 shares. The one share is split into 4. So but what will happen, that the price of that share will drop down to 12.5 because remember, we are saying that there is no other economic changes. Remember that the company performance has increased or decreased during the same time, but on a particular split of a second, when the company split its shares, one share into four, so its number of shares will become four times higher, while on the other hand the price will drop down by one fourth. So in that case, the number of share that you are actually holding, so remember, these are not the number of share outstanding of a company, these are the number of share that you have purchased as an individual. But the overall company share will increase by four times, so the number of share that you have purchased, that would also increase by four times, so you will have 400 shares. We will discuss, remember that we will discuss the calculation of these things in more detail in our video, which will be based on Excel, but for the time being we are actually just understanding it, that how it works. So the global equity indexes, there are stock indexes available for most of the individual foreign markets. So you start from, let's say, New Zealand, Australia, and you go to like Mexico and Brazil, you will have stock markets everywhere, and you will have, there are indexes in each market. In Pakistan we have at least the well-known indexes that we have KC 100 index, we have KC 30 index, we have KC all share index, and remember, then we have some Islamic indexes as well. These are closely followed within each country. So we are following KC 100 index in New York. In the US market, you follow the Russell 1000 index, you follow the S&P 500 index, you follow the Dow Jones Industrial Average 30 industrial average. So in each country, the investor, they refer to their own index and they follow their performance, and then they compare their own performance to them. These are difficult to compare due to differences in sample selection, weighting, and the computational procedure, because each index can be different. Even in the Karachi Stock Exchange, we have different sizes. All share index mean all the companies are being included, 30 index mean only 30 companies are being included, and their selection criteria can be different, how the companies are being actually being selected, and then the calculation method can vary, that some may be price weighted, some may be value weighted, and some can be equal weighted. And these groups have computed, there are certain groups, financial groups, which are actually calculating the indexes from for different countries. So MSCI, you can say, there can be different investment banks or financial service providers, they are developing the indexes for the emerging economies, for the developing economies. So there are different ways in which the indexes are being calculated. Let's come to the interesting point of this discussion. This is related how the KC 100 index is being selected. So for all those individuals who want to know that how the KC 100 index is being selected, mean how the 100 companies are actually being selected, this portion of the presentation is very important for them. So the KC 100 index was introduced in November 1991 with a base value of 1000 points. As I told you that if you go through my entire video, you will say that the initial value was assigned to the KC 100 index was 1000 points, and it was in the November 1991. The index comprises of 100 companies selected on the basis of sector representation and highest free float capitalization, which captures around 80% of the total free float capitalization of the companies listed on the exchange. Remember that the initial, in the November 1991, it was not based on free float capitalization. It was based on the total capitalization, but then it has been changed recently mean that in after 2012, it has changed to the free float, and we will discuss how the free float are, what does it mean and how it works. So it comprises of 100 companies, clear? And the selection procedure is in two steps. Number one, that it is it is sector based, and the other one is the free float of the highest. So we'll discuss it in detail in the next slide as well. There are total 36 sectors. Remember, these sectors keep on changing, so I'm talking about May 2020. There are 36 sectors listed on the Karachi Stock Exchange, or Pakistan Stock Exchange we call it nowadays. It is given in the next slide. We will see those sectors at 36 sectors. But out of those 36 sectors, we exclude one sector, that is the open-ended mutual fund. Open-ended mutual fund, we exclude this one sector, and 35 companies are selected, one company from each sector, excluding this one, on the basis of the largest free float capitalization. So there are 100 companies to be selected. So 35 are selected based on whichever company is having the largest free float free float market capitalization of it in its own sector. So let's say there are 20 companies in a particular sector. So whichever company has the highest free float capitalization in that particular sector, it is automatically selected into the index. So 35 companies are selected like that, and the remaining 65, in the remaining 65, let's say there are total, I'm just taking a rough figure of, let's say there are 500 companies listed on stock exchange. I'm just excluding the open-ended mutual fund sector, mean that has been excluded. The other companies, they are, let's say, 500. So out of, and there are total 35 sectors, so 35 companies will come out of 500 based on whichever company is the largest in that particular sector. 35 companies will be selected like that. Now the remaining 65, there will be 465 companies remaining. 465 companies remaining. Let's say if there are total 500 companies. So those 465 companies are then arranged in the order of largest free float capitalization to lowest free float capitalization, that is in the descending order, and the top 65 companies are then selected. So 35, whichever is the highest company in a particular sector, and the other 65 are then irrespective of the sector consideration, they are selected based on the descending order of their free float capitalization. So this is how the 100 companies are being selected. So the KC 100 index represent all the sectors excluding the open and mutual fund sector. So it has at least one company from each sector, and then the other 65 companies are selected irrespective of the sector consideration. So there can be sectors which may have all of its companies included in the index, and there can be sector which has only one company, that is which was selected based on the sector, but no other companies being included because the sector has smaller companies and therefore no other companies being included. While there can be some sectors from which, let's say if they have 10 companies, so the one company was selected based on the sector basis, and the 9 remaining were so large in size that they were also included in the index based on, because they fall in the top 65 companies, therefore they are all being included. So it has representation from all sectors, and it has, then the 65 companies are based on all the free float companies, so it means it representing the largest companies as well. So this is how the KC 100 index is being selected. These are the 36 sectors. So starting from the open-ended mutual fund, and remember that this has been actually excluded, this is not being considered, no company is selected from this one. Then from close-ended mutual fund, mudarbas, leasing, and you go down to see that there is transport, there is technology and communication, fertilizer, and going to glass and ceramic and miscellaneous. So excluding this first sector, from each sector the top companies being selected into the index, so 35 companies selected like that, and then the remaining 65, they are being selected whichever companies are included in these sectors, in these 35 sectors, they are being arranged in descending order of their free float market capitalization, and then the 65 companies are selected like that, so it makes it total of 100 companies. Now how we determine the free float, that is an important thing. So let's understand it. Determining free float factors, how much, what do you mean by free float? The listed companies shall submit their pattern of shareholding in the prescribed manner to the exchange. And remember, generally companies, they publish their shareholding pattern in the annual reports as well, there you can see as well. But then in the stock exchange, they ask in a specific format, in which what they do is they need to classify the number of the shareholding pattern in terms of how many shares are actually being held by the directors and the controlling members and government. So what the exchange will determine the free float, you know, the of each company. Free float factor is a multiple with which the total free float market capitalization of a company is adjusted to arrive at the free float market capitalization. Once the free float of a company is determined, it is round off to the highest multiple of 5, and each company is categorized into one of the 20 bands given below. So I have just taken in up to 35%, but it goes down to ultimately 1, or you can say 100%. So whichever company it has free float, I will share a separate PDF file in which you will understand it further. But total company share there, let's say they're a company which have very large number of shares, but I'm just taking a very small number. Let's say if a company has 500 share outstanding. Out of those 500 shares, let's say it's 475,000 shares or 80,000 shares are held by one family or two families, or you can say a controlling group, which are not going to sell their shares. Only around 20 to 25,000 of its shares they are being outstanding, with the general public, they are actually being traded. So it means 20,000 divided by the 500,000, and the answer that you will get will be around 4%. So it means its shares are 4%, free float shares are 4%. So any company which has greater than 0 but up to 5%, it will all fall in the 5% category. So the company that I'm referring to, which has 4% share outstanding with the general public and which can be traded, it means that company will have a factor of 5%, 0.05. Now let's say if that company has a share with the general public around, let's say 30,000 or 35,000 or 40,000, so in that case it will fall into the 10% category. If it has more, it will keep on increasing. Let's say if all of its 500 shares are with the general public and which can be traded at any point, nobody is holding the shares as a controlling share, it means we will go down and we will see that it will be equal to 1. It means, so if the value is more than 95%, 96% or 97% of its shares are outstanding and they are with the general public and it can be traded at any point of time, so then this factor would have been 1. So that free float factor multiply by its total number of shares and then multiply by the price of that company, that will determine the free float market capitalization of the company. Now here comes the stock selection, how the stocks are actually being selected. So I'm explaining that first slide based on the KC 100 index in more detail here. So this stock selection rules, the first we will start with the selection criteria for stock inclusion in the recomposed KC 100 index are, how it is being selected. The largest free float capitalization in each of the 35 Karachi Stock Exchange, which is these days we call it as Pakistan Stock Exchange sector, excluding the open-ended mutual fund sector. So in all the 35 sectors, whichever company has the largest free float capitalization in its own sector will be selected into the exchange, or the KC 100 index, mean the 35 companies will be selected like that. The remaining index places, in this case 65, are taken up by the largest free float capitalization in the descending order. So whatever is the remaining companies in the index, those companies are arranged in the descending order of their free float market capitalization, and the top 65 companies are being included, are selected. So this makes 35 plus 65, it makes it 100 companies. Company which is these are some factors that such companies cannot be included into the index. That companies which is on the defaulters counter, or it is trading is suspended by the stock exchange, or it is declared as non-tradable in the preceding 6 months from the date of recomposition, shall not be considered in the recomposition of the KC 100 index. So for example, if there can be a situation, the company may be the top company of its sector, but it is being declared as non-tradable, or its trading is being suspended by the exchange. So even though that it is the largest company of its sector, it cannot be part of the 35 companies that we are selecting. Or similarly, that the company may still fall in the next 65 companies, in the descending order, but since it is been suspended, or it has been declared as non-tradable, so this company cannot be part of the KC 100 index. This is how the KC 100 index is actually being calculated. The next thing is the recomposition of the index. So this maintenance of the index over the time requires an ongoing semi-annual. So after every 6 months there is a reconsideration, that it does not mean that those companies which were selected in 1991 for the first time to include in the KC 100 index, they still remain in the index. Companies can be replaced. New companies can beat another company based on the market, free market capitalization, based on the the sector, or it can be some new company can enter into the top 65. So recomposition take place. So semi-annual recomposition process actually takes place. The recomposition rules fall into two general categories. What are those general categories? I hope you are clear that one is the sector rule, that a company which was previously the top company of the sector, but let's say another company has replaced it. So it means that now the new company will be part of the index. And the second one is the free float capitalization rule, that is for the other 65 companies that are being selected. So let's say if the previously another company was one on 65th position, and there was another company which was on the 66th or 67th or 70th position, but now the company has performed better and its value has increased, while the company on the 65th position could not perform very well. So it means the 70th number company will replace the 65th number company, and that is the free float capitalization rule. We will explain it in more detail here. The sector rule governs the selection or the deletion of the companies on the basis of being the top free float capitalization stock in each of the 35 Pakistan Stock Exchange sectors that we have discussed. So if you are the topper in a particular sector, you are included in the index. But if you lose your position, so another company will take the position of the company which is losing. There are two rules which govern that how an existing company will be replaced with the new company. So one is a time based rule and the other one is a value based rule. These two rules are recommended to undertake the selection in this area. The first one is a time based rule and the other one is value based rule. And how they work: the application can be triggered by compliance with either of the rule, whether it comes under the time based rule or whether it comes under the value based rule, and I'm explaining it on the next slide. Time based rule, what does it mean? That a company not in the index previously, remember that it was not part of the, it was not the largest company of its sector previously, which become the largest in its own sector by any amount of value. Remember that previously the previous company which has been included has a market capitalization of, let's say, 1 million, and the other company was having like 9.95 million. So but now this company in the next recomposition period, that its value has increased to, let's say, beyond 10 million, while maybe 10.2 million and 10.1 million or 10.5 million, while the other companies still remain at 10 million. So it means that it has increased in value, clear, by an amount of 0.5 million, will enter the index. But remember, there is one point, that it will not be automatically enter, it will take some time. That's why we call it as time based rule. Will enter the index after maintaining its position as largest in the sector for 2 consecutive recomposition period. And remember, the recomposition periods are 6 months. So if a company maintains its top position for 2 consecutive periods, so then it will be included. Remember, if a company increase in value from its first company only for 3 or 4 days and then it drop down, it will not be replaced. So it means that it should maintain its position for 2 consecutive recomposition period. And the value based rule, it means that as a company not in the index which become the largest in its sector by a minimum of 10% greater in the capitalization value than the present largest in the sector, in which is included in the index, will enter the index after 1 recomposition period. So in the first case, it can be only increased by 0.5% or maybe like 2% or 3%. For that case, you have to maintain your position for two consecutive recomposition period. But if your value increased by 10% more than the existing company, which is actually included in the index, and the value of the new company has 10% or more than 10% higher than that company, so if it maintains that position for one recomposition period, it will be included. The second one is the free float, the selection of the 65 companies that was based for the sector. Now it is based on the other 65 companies, how the 65 companies are being selected. So capitalization rule governs the selection or the deletion of the companies on the basis of being among the largest free float capitalization in the stock market. So only one rule applies here, that is time based rule. And how it works, that a company not in the index may qualify for entry if it exceeds the market capitalization value of the last stock in the index selected on the basis of market capitalization for two recomposition periods. So whichever company which was the last, the 65th on the market capitalization basis, if any other company it exceeds its value, which that company may be on the 66th position previously, or 67th, or 80th, or it can be even on 90th position, but it performed very well, and it become you know on the one of the companies which is now can be 65th number, or 64th number, or 60th number. So what it will do is that based on that, if it keep its position for two recomposition period, so then the last company out of the 65 will be pushed out, and this new company will be included into that, and this is how the recomposition will complete. So a qualifying company automatically pushes out the lowest capitalization the selected stock in the index. So whichever company was in the bottom, that will be out, and this new company will be included into the index. This is how the KC 100 index is actually being selected. I hope you understand. Thank you so much.